Warning, this video and all other videos on this channel are for entertainment purposes only. The content of this video and all other videos on this channel are the opinions of the creator only and do not constitute legal, trading, investment, or financial advice of any kind. Investing carries a high level of risk and the majority of retail clients lose money. Do not invest any capital unless you understand the risks and you are prepared to lose it all. Alright, hello and welcome to Camel Finance. I'm your boy Camel, and today I've got some awesome Bitcoin stuff to show you as always. But to be completely honest, I'm getting pretty close to calling tops in the stock market. And it's not something I want to do by any means, but at the same time, the market is going to prove to me what the market is going to prove to me, right? I don't get to choose what the market is going to do. I just get to be an objective observer, and I'm not quite ready to call major tops here. But I am looking at this and thinking to myself, it's starting to look an awful lot like we are not actually going to get a third and final blow off top angle. It's starting to look a lot more like we might just be about to experience a normal topping structure, similar to what we had back here, for example. Okay, so we get these kind of sell-offs, a slightly or marginally higher high or higher low, followed by a little drive up, and everyone gets kind of bullish, and then the thing just kind of rolls over and dies, right? And those kind of topping structures are actually a lot more common than blow-off tops. Now, the reason I've been expecting a blow-off top is because we're at the end of multi-decade cycles, and typically that's how they end. But if the market's not going to give me a blow-off top, then, I've got two options. I can sit here and keep championing it, or I can just respect the fact that the market doesn't actually look like it wants to give me one, and instead it looks a lot more like it's thinking about just having some kind of marginally higher high and then rolling over and dying. And ultimately, if we zoom out and think about what the base case hypothesis has been, it was that at the lows, everyone was too bearish. We were going to scream up to new all-time highs. From bottom to top, the S&P 500 did over 61%. Okay, now when you really think about this, that means with an average annualized return of 6 or 7% for the S&P, we did about a decade's worth of gains in about 18 months. It's not like this doesn't qualify for a big rip-roaring rally to the top. And remember, if this call is going to be correct, then the second portion of this call was that we were going to have a bear market and a global recession. And if, of course, we're going to have a global recession, then we would need to see unemployment spike. We would need to see the labor market deteriorate. That's what we're seeing. We would also need to see inflation start to come off rapidly. So far, I think that's the case. Obviously, that's going to be confirmed next week at the CPI on the 11th. We were also the entire time expecting rate cuts to occur within around 2 months of the top. Okay, and we know that rate cuts are coming, as I'm going to show you in a minute, in about 2 weeks' time. All of this is occurring against an inverted yield curve that is just starting to revert. Again, we're going to talk about that. But when I zoom out and look at this, okay, more or less, this thing went according to plan. Now, yes, it would have been nice to get a final blow-off top angle, and I'm not discounting that completely. It's certainly possible that we do see some kind of sell-off into the CPI on Wednesday, and then we get a rip-roaring third and final angle. This is the dream setup. It's the easiest to identify. It's the easiest to sell. It gives us the nicest short entry at the top, okay? But the market doesn't always give you that. And if it's not going to give us that, then, like I said earlier, I got two choices. I can either sit here and keep pumping my fists in the air and screaming, blow off top, or we can just acknowledge that maybe that portion, the third and final angle, is going to be missing. Maybe that component of this hypothesis is going to be missing. And if it is, it's no good me sitting here saying third and final angle's coming if what we're going to do is something like this and then roll over and die, right? So as ever, there are no certainties in trading. Trading is really just probabilistic outcomes, and we as traders use our entire experience in the markets to let us know which we think, based on our experience, is the most probabilistic outcome. Now, like I said, I'm not ready to discount the third and final angle yet, but my experience, all the time I've spent trading and studying markets, tells me that this isn't really looking like a third angle should look, okay? A third angle should look something akin to this, okay? And whilst, like I said, we can't quite discount that third angle's coming just yet, the more time we spend moving down, the more time we spend kind of chopping, the more it tells me we're probably going to form a top similar to how we did back in 2022. And this is by far and away the most common type of top for the stock market. Okay, the blow-off tops are actually quite rare. So to be clear, I'm not quite ready to call tops here, and I'm also not quite ready to fully discount the blow-off top angle. But I do think, wholly speaking, okay, this hypothesis, this first half has played out. Like I said, we've had the big run. We've had a decade's worth of returns in 18 months. We know that rate cuts are coming, okay? If that was the top, then what was the date on that? End of July, mid to late July, okay? And what was the expectation for the top? July/August, right around the time of the Olympics. We also expected those rate cuts to form within about 2 months of the top. So if we get the rate cuts in September and we see a top somewhere around here, again, that'll be another one we can tick off. So wholly speaking, like I said, it's more or less played out, okay? And for this recession portion to play out, What do we need to see? We need to see inflation drop like a stone. We need to see a small, short period of asset price deflation. That will happen only after the stock market sells off, if of course that is in play. And the key part is the unemployment data needs to deteriorate rapidly. Now, with that in mind, okay, this week we've had plenty of unemployment data come out. The private sector had a massive miss, 99k versus 144k estimated. The initial jobless claims were not quite so bad. And today we've got US non-farm payroll. So overall, like I said, when we're looking at this recession and this bear market supposedly unfolding, we need to see labour market deterioration. That's what we've been seeing. Now for me, the canary in the coal mine the entire time has been that we all know they keep releasing data only to quietly revise it downwards shortly thereafter. Okay, and I've been making the case that why would they do that? I think if everything was actually fine, if there was no real risk of massive spikes in unemployment and therefore some kind of recession, I don't think they'd have been trying to cover it up and make it look better than it was. And this is continuing to continue. This whole fudging the data, pretending like things are okay, I still maintain is a canary in a coal mine. As of yesterday, the predictions and expectations for today's jobs data dropped by 26,000 jobs in 24 hours. The prediction market expected 174,000 jobs to be added in August. That is now down to 159,000 jobs. And here's the key part, okay? This comes after the private payroll posted their smallest gain since 2021, and the previous month's data was also just revised lower by another 11,000 jobs. What is happening with the labour market? Okay, again, I sit here and suggest to you that this is a controlled demolition. Is it that we can see it and the Fed can't? And I know a lot of people like to think they're smarter than the Fed. I understand that. And we see this whole everyone's an expert phase at the moment. I keep seeing something that really grinds my goat as well. I keep seeing people talking about using other people as exit liquidity. Retail will come back so I can use them as exit liquidity. This shows you how inexperienced, how much of the market is completely comprised of total rookies, arrogant rookies. Why do I say this? Okay, because you don't need exit liquidity for your $1,000 or $2,000 position size. You don't even need exit liquidity for a $100,000 position size. Most people aren't trading 100k lots. Okay, they're just not. That's the reality. And yet they sit here on Twitter all day typing out, "I can't wait to use people as exit liquidity." Brother, the market maker will buy your stuff directly from you, okay? When you go on Coinbase to sell your ape coin, there's no exit liquidity there for your tiny little size, okay? But this is where we've gotten to in the market. Everyone thinks they're Warren Buffett and Michael Burry. Like I said, they continue to lie about the jobs data. They continue to make this stuff look a lot better than it actually is. And when we compare the current labour market deterioration to prior recessions, okay, it has all the familiar symptoms. Look at job openings, okay, crashing to the downside, just like it did prior to the recessions. The job openings rate of change, okay, exhibiting the exact type of behaviour, in fact, worse than some of the prior instances that saw recessions. Non-farm payroll, okay, crossing below the zero line, that's probably going to be confirmed today. And at the same time, unemployment spiking, okay, curling up. So how is it that we can see this? How is it that we sit here and say we should expect all of this stuff to occur right around July, August, September, whatever? This is exactly the stuff that we're getting right before our eyes. And yet most of the market is sitting there believing the Fed. Most of the market is sitting there saying this is no way a controlled demolition, the Fed's in control, or worse still, they think they're smarter than the Fed. Okay, the Fed know what they're doing. The Fed absolutely know what they're doing. They're doing this deliberately. They are looking at the exact same data as we are. Do you think that we're honestly smarter than the Fed and they're incompetent? No, they're not, okay? They know what they're doing. They're deliberately creating a deflationary bust and a global recession. And that is why they've been so late to cut rates, okay? And the other thing about this is there's a lot of debate at the moment about whether or not we're going to see a 50 basis point cut or a 25 basis point cut. There's a lot of people arguing and infighting about which one of these could be more bullish or more bearish than the other one. The reality is, okay, they're already very, very late. We know inflation is coming off. The labour market is falling apart. The stock market is currently looking or thinking about at least putting in top-in structures. And the likelihood is, okay, based on their prior behaviour, based on the fact they've already shown a very stubborn approach to rate cuts, they could have cut in July's meeting. They chose not to. They chose to dig in their heels for a reason. Is it reasonable then to just say, well, now they're going to start to be accommodative? I don't think so. I think they're most probably going to do the 25 basis point cut, even though they should do a 50 basis point cut. And again, it's not ignorance or incompetence. It's not that we're smarter than the Fed. It's that the Fed knows what it's doing, okay? The Fed knows exactly what it's doing. And with policy already too tight, with policy already behind the curve, okay, not moving straight to a 50 basis point cut, it's just going to make this whole topping process quicker. It's just going to make this whole recession and bear market a lot faster. And again, there's still a whole heap of so-called experts out there that sit here and say rate cuts are bullish, bro. Rate cuts are bullish. They don't even know what they're talking about, right? We're not cutting into normalization here. We're cutting against a backdrop of deteriorating unemployment and an inverted yield curve that's now reverting, okay? Now, the nuance here is once it reverts above the zero line, we don't have to immediately start calling tops and recessions, okay? But what we usually see is an acceleration to the upside that lasts a few weeks, maybe a couple of months at the most, and that is where we start to enter true recessions. So again, like I said earlier, I'm not fully ready to call tops here, but I have to just hold my hands up and say, when we look at these charts, it's starting to get very, very, very ominous if you have been here any longer than a couple of years, okay? If you actually have any experience trading charts at all and analyzing charts at all, then it's hard to make a case at the moment that this thing looks ultra bullish, especially against a backdrop of a yield curve that's about to start to accelerate to the upside, a labor market that is falling apart at the seams. All the while the Fed is sitting here and quietly revising the data down, trying to pretend like it's not falling apart at the seams. I mean, alarm bells should be ringing, in my humble opinion. And by the time we get to these rate cuts, like I said, they're probably going to dig in their heels again. Why would we expect their behavior to change? Why would we expect them suddenly to do a 180? Suddenly to start caring about the markets and caring about everyone else? They don't care, okay? They're doing this deliberately. And so what does it mean for the stock market? What does it mean for potentially seeing a recession? One more time, okay? It means that the expectation has more or less played out. The tops are more or less forming in the expected timing window. We're also overdue for a 4-year cycle low by a good couple of months. We also know the rate cuts are coming right around the time they were expected to come and right around the top. And we also know that, at least for now, okay, and we can only use the data that is in front of our eyes. We don't know what the following candles are going to produce. But right now, based on what we have in front of us, it looks an awful lot like a regular market top in structure. So there is always a chance that we're just going to backfill this gap, okay, print a slightly later than expected half cycle low, and then come screaming out of here. There's always a chance that that becomes our third and final blow off top angle, okay, and happy days, long and strong, everyone gets to have the easiest exit ever. There's always that possibility. But the more downside we experience and the more this structure starts to take on this kind of wobbly shape, okay, this kind of sideways grind, this distributive type pattern, then the more likely it is that we have already seen the top, or any future top to come is only going to be marginally higher than that. And so, like I said, I am not 100% ready to call tops yet, but I am closer than I've ever been. And something else that's really important, right? All my analysis shows that by the time we get to CPI, we're going to see for the first time the most significant drop in the CPI data. We should be experiencing, rather than just, you know, a 3.0 becoming a 2.9 and then a 2.8, we should be going from 2.9-ish to 2.4 or 2.5. This should be the first true drop in CPI that has the rest of the market scratching their heads going, whoa, I thought inflation was sticky, right? This should be the first print that really shows that the Fed is super, super late. Inflation is going to start to drop like a stone, and the risk is deflation, not continuation of inflation. But as everybody knows, okay, they changed the way they calculate the CPI basket right around the time that Trueflation and the US government reported CPI rate was starting to prove that continuation in disinflation was the base case, okay? That was at the start of the year. They changed the way they calculate the basket again. And since then, we saw big divergence between Trueflation's readings and the government reported rates. So just like any other data, we can't even really trust the CPI data. And the reason I bring this up is because let's just say we walk down continuously into that CPI and it comes in hot. What if it comes in sticky? What if either I'm wrong or they make the data up? It's irrelevant, right? If the print is anything other than a very, very cold surprise downside print, do you see this market rallying? I don't. Okay, I think it seems completely unreasonable. What seems much more likely is if that print on Wednesday comes in hot, off the back of all of this labour market deterioration that we've been seeing this week, it seems only reasonable that the market's going to continue down. And at that point, this thing will have all the familiar symptoms of a major top in structure. So I am by no means ready to call tops. Let's be really, really clear, because I talk very fast because I'm very passionate about this stuff. And I know people can't really follow it a lot of the time, or I say one thing and it makes their mind wander and they start to worry about whether or not they're going to lose all their money and blah, blah, blah. So let's be really, really clear exactly what I mean when I'm saying all of this, okay? Number one, I am closer than ever to calling tops, but I am not yet ready to officially call tops here. Number two, I still hope that we can indeed get a surprise cold print, a blow off top angle, okay, and we can do normal Camel Crew stuff. Sell the third angle, look for shorts, declare victory on the whole blow off top thing, okay? I'm not ready to discount that yet. But what I am saying is, if this doesn't turn around pretty much immediately, then it's no longer exhibiting the characteristics of a blow off top, is it? It's not looking like a third angle anymore. We've had one here, we've had two here. If the thing doesn't start to go vertical, then we just don't have a third and final blow off top angle. And we have to acknowledge that. When the market speaks, we have to listen. Not to mention, if somewhere in this neighborhood there is a top, okay, then wholly speaking, that will be exactly as expected in terms of the time, in terms of the rate cuts showing up right around that neighborhood, which we know are coming in a couple of weeks' time. The macro backdrop indeed is as expected it would be moving into this downside period. Okay, we have got the labor market deterioration. We are likely going to confirm that CPI is indeed going to come off. We are therefore going to be cutting into a slowdown rather than normalization. And that historically is very, very bearish. So wholly speaking, not too far from expectations. There is absolutely still chance to come swinging out of a CPI print and set a third and final angle. Equally, there is every chance that we are going to do something like this and die from here. So I wanted to be completely clear about that. I wanted to make sure that you guys understand I am closer than I've ever been to calling tops here, and it's not really outside of the expectations. Yes, I would have liked to see a bit more push to the upside, but the market doesn't always give you what you want. Again, when we look at the Dow Jones, okay, we've had our three angles. Now, is this one about to be set from here? Are we about to do something like this? Maybe. Okay, or are we about to break down again, lose this second angle, and then what will we have? We would have a completely classic shaped, normal and to be expected topping structure. Okay, so again, it's not about what I want. It's not about what I hope would happen. It's about staying on the right side of the market. If this thing really is going to morph into a distributive type pattern, then it's going to be time to get out of this market pretty soon, and for me to be officially declaring tops, whilst still being aware that a CPI print could indeed potentially save us. So there's nothing easy about it. We have officially left easy mode. Now we're in difficulty mode. Now we're trying to find the top. And if we go back here, okay, look how long this top took to form. Okay, all of this is a large topping structure. And it wasn't until sort of in this neighborhood that people start to realize maybe, just maybe, it's time to get short. Then, of course, we get a violent snapback. And only in here, okay, is the bulk of the move nearly over. And it doesn't become obvious to everyone until it's far, far, far too late. If I copy and paste this topping structure, okay, it's entirely possible that we're doing something in this neighborhood. Okay, it's entirely possible that something like this is occurring. And so, like I said, I am closer than I've ever been to declaring tops, although not officially ready to do so just yet. Meanwhile, we were looking to see if breadth could widen. Okay, so far, marginal improvements, but it's got a long way to go. Again, maybe the CPI can save this market. Maybe we can get a really cold surprise print, show up on Wednesday, and then something like this. That would be the best case scenario. I'm also noticing a lot of these structures for Coinbase and stuff, right? When we got this breakdown, I cut the position. So we got a core allocation at the lows, we got multiple trades on, caught all of this, and then ducked out here on that yen carry trade unwind. Okay, and in this neighborhood, a whole heap of people were laughing at it. They were saying, you know, just buy the dip, bro. And I was saying, look, this is not going to fly. We have to manage risk. And now, so far, they looked right for a few days, only to be very, very wrong since then. Now, is this a double bottom? Okay, do we see something like this? And off we go. It's always possible on a lower CPI print, okay? It's always possible if Bitcoin breaks to all-time highs, this is what comes next. But it goes to show, okay, you have to lock in your gains. You have to protect your capital. Like I was saying, you know, we were long for this entire move on the way up. And sure, we gave back this top section here, okay? But we caught this and protected the risk. And there's nothing to say this isn't coming next. Okay, particularly if we're about to enter a recession. What if Bitcoin's not going to break out to new all-time highs? You know, the signs will have been there. Similar deal for Nvidia, right? Nvidia's been the darling, but here's the deal. Nvidia led on the way up. It's undeniable that Nvidia was a leader. But what do we know about leaders? We know two things. Number one, leaders lead and laggards lag. And number two, leaders lead on the way up and on the way down. Okay, so everyone knows this was a leader on the way up. This was carrying the stock market on its back for a long time. But if we really are getting into that neighborhood where it's time to expect recessions and bear markets across the board, then we would expect the leaders to lead on the way down. Now, so far, what do you see? Okay, I see something that looks pretty ominous in Nvidia. It looks a lot to me like it wants to think about doing something akin to this. So if this is going to lead on the way down, wouldn't it fit with a stock market index that's doing something like this? I think so personally. Just something to be aware of. Again, we could easily see this market saved. Perhaps the second angle that I've got drawn is not the correct one, and we should be using something like this, okay? In which case, maybe we've got a little bit more downside into CPI, and then a rip-roaring third and final angle. Perhaps that is the way. But again, it looks an awful lot to me, okay? Like the signs under the hood are slowly but surely confirming that we may well be right in that expected window to start to see tops come in. So again, let me be really clear, not calling for this necessarily, okay? I think it's much more likely that we see some kind of chop like this, and I'm still very hopeful that we get a third angle. But so far, okay, based on everything I've shown you, I think it's warranted to say caution is the best strategy here. I'll also add one more thing in here, okay? The people that were talking about me not buying the dip here, me not going back to full exposure right away, me being quote unquote gun shy for only adding 1 or 2 positions across multiple asset classes and saying that I wanted to build my exposure slowly, you know, if this thing continues to bleed, then it's going to become very, very obvious once more who the people that can manage risk are versus who the people that cannot, right? So a truly wild time to be alive. There may well be a couple of weeks left, but on a balance of probabilities, I am leaning on not seeing a blow off top just yet. I'm leaning on seeing probably something much more akin to a regular top in structure. Of course, if the market proves me wrong, if we do get a blow off top angle, then we've got a good track record of catching that as it unfolds. Over in the world of Bitcoin, what a time to be alive. Who thought we were going here today on a Friday, right? But over in the world of Bitcoin, we got MasterCard launching a crypto card linked directly to your private wallet, and they've already got 100 million merchants across Europe. So you can pay with Bitcoin and crypto at 100 million merchants. Adoption continues to continue. Meanwhile, we've got this $290 billion bank in Zurich offering crypto. And what's most fascinating about this is they have a AAA rating, which is very, very, very hard to attain. Very, very few banks actually have a AAA rating. And the news just keeps getting better under the hood because Venezuela are proposing to use Bitcoin as a national reserve asset. Meanwhile, the fear out there for Bitcoin is very, very low. We have entered extreme fear, which is not nothing, okay? Usually, when we see extreme fear like this, we do get some strong relief to the upside. I wonder if that CPI print on Wednesday can actually save not just the stock market, but Bitcoin in the short to medium term. Meanwhile, the supply on exchanges continues to dive. Okay, this is it in purple here. So large players are accumulating. They're slowly but surely draining the exchange reserves, which of course is bullish. The blue line is the 2015 to 17 and the 2019 to 2021 bull markets averaged. The dotted grey lines are standard deviation ranges above and below. Look where Bitcoin's current cycle in red is. It has majorly deviated to the upside when it made that 73, 74k top. But since then, it has had this big mean reversion that I've been talking about a lot lately. And we are now right back on schedule for the average of the 2015 and 2019 bull runs. Again, it tells us to keep an open mind about seeing Bitcoin do Bitcoin things once more. However, there is a caveat to this, okay? I see an awful lot of people championing rate cuts being bullish for Bitcoin. Okay, but this chart is just incredibly disingenuous. We're saying rate cuts are bullish for Bitcoin. Look at this, okay? But the reality is, we had a top here of 14k, and during the C19 plunge, we may or may not get another demand-destroying event like that, okay? Maybe it was just pushed down this low because of the Black Swan event that showed up. But the reality is, objectively speaking, this was not bullish, okay? These cuts saw Bitcoin drop from 14k at a high to 3k at the low. And whilst it doesn't show on this line chart because a lot of that was wicks, okay, that's not nothing. It's hard to say, well, rate cuts are coming, so that's bullish Bitcoin. Okay, that's not what we saw the one time Bitcoin has ever seen a cutting cycle. In fact, like I said, it dropped from 14k to 3k. Ultimately, yes, it did resolve to the upside, but are you prepared to hold through a 60 or 70% drawdown at the onset of a cutting cycle? However, one little piece of hopium, just before we get into a couple more charts, is we have the prior bull run, okay, shows here, which tracked the Wall Street cheat sheet pretty well. And now when we overlay the current bull market, okay, it looks an awful lot like we are right into optimism, although the backdrop currently does not feel optimistic at all. But if that's the case, then we still have belief, thrill, and euphoria left ahead of us. Could we see something like this in the face of a recession? Or can we manage somehow to swerve a recession? Can we manage somehow to just see Bitcoin continue to do Bitcoin things, not go into a recession? We'll ignore the inflation data, we'll ignore the unemployment data and all of that stuff, and we'll just continue to go up only forever because liquidity is up only until the end of 2026. That is to be determined, but it is undeniable how well this current structure fits at this moment in time. Like I said, the only missing component is that final fifth wave to the upside, that third and final blow off top angle. Time will tell, as always. We have largely speaking done the charts. I'm going to come back over the weekend and do the deep dive as always. The only chart we haven't really covered is Bitcoin. Bitcoin's still trading kind of the same as it has been for many, many days now, right? We are still looking to see if we've got either a cycle low about to show up, which will undercut this low, or whether we're going to make a higher low here, confirming this as a cycle inversion. And then we should be looking for some bullish price action. The price is currently still making a higher low. So we're going to find out until stopped out and invalidated. Then I continue to stand with this posture. And one thing we have got in our favor is the dollar index continuing to look a little bit on the heavy side. So I like to see that for sure. The yield's continuing to come off there, so happy days. And as ever, we'll just keep taking it one day at a time. The good news is we only have a few more sessions to get through until that CPI data, and then we should be able to make some final decisions on what is the base case here. Is it the blow off top? Is it a distributive top? Or if we get a scorching hot print and a sell-off, then do we have to start declaring tops are already in? I know it's going to be a nail-biting few days for a few of you, but to that I simply say, manage the risk, okay? Size down, protect your gains, do the right thing, be a professional, and everything's going to be all right. I'm your boy Camel. I hope you're doing well in life. Have a great weekend. Cheers. Bye.